All right, all right, all right. Are we ready to rock and roll? We are getting ready to go in and do a little day trading today. We're going to do the simplest form of day trading that I think that we can do and still find a little bit of success in this crazy world of day trading. All right, so we're going to start off with something that makes it easy for most people to get started. All right, so if you're brand new to day trading and you want to get started, here's a couple of my recommendations. First of all, I've been doing this for about 35 years. All right. I've been in the trenches for a long time. And I've seen a lot of day traders come and go. And I've discovered one of the simplest way to do day trading is over in the futures market. All right. Now that's kind of where I got my start anyway, is out in Chicago at the Chicago Board of Trade at the exchange there. And the Board of Trade, well, the two exchange, Board of Trade and uh, the mercantile exchange. And so that's where I got my start. Now I was in the education center and I was teaching trading back then when I was there. So I've seen a lot of people come and go and do a lot of different strategies. And there's a lot of strategies out there and you can make them very sophisticated and you can, get really crazy with them. But in my experience and what I've seen, most traders have the greatest success just keeping their strategy just super simple. Now, I think a super simple strategy that's been optimized or automated is actually the best strategy. But we need to go through the steps of understanding the strategy first, then we can automate it. All right. And what we're going to do is we're just going to have the computer help us execute our trades for us. And that's generally the easiest way. Now, the first thing that we have to do is we have to realize the computer can't make money if the market's not trending. All right. So if you're going to day trade, we're going to look for a trend. All right. Now there's scalping strategies, and scalping strategies mean that you kind of just get in and you're only trying to get 5 or 6 ticks, just very small little wins, but you get a lot of them. All right. So a lot of little winners stack up to be a lot of money. And the other thing that we need to talk about is trading in the futures market out of Chicago versus trading in New York out of the New York Stock Exchange. Now, we're not going to be trading stocks today. We're going to be trading the stock indexes. And what we're looking at in particular, the one I like is NASDAQ. And the reason I like the NASDAQ is because it moves more. All right. It's more active. And we need more action. We need more volatility in the market to make our money, to get a little trend going. But if the market's not trending, even an automated system that's very simple and very powerful can't make money. I mean, if you're going to be day trading, and unless you're willing to just, do some real short-term scalping, you need to catch a trend. All right. You need to catch a little bit longer trend. Now we're going to do something a little bit halfway in between. We're not going to scalp for 5 or 6 ticks, and then we can do a little bit of that. But today we're just going to try and not stay in for 2-3 hours. We're going to try and catch these smaller trends. All right. So like these moves right here. And you see these little moves in here or this one here. This is what we're going to try and capture. All right. These little moves in here. But if the market's like right now being kind of stupid, is not really making these trends, it's kind of, the market's quite lazy right now. And so technically speaking, you don't want to be trading during lazy markets, because even in lazy markets, an automated system that works really well is a great system, generally can't make money because the market's just not moving. So what we want to do is we want to find a time in the market where the market's actually making nice moves. Okay. So if you're trading and you see the market doing this kind of thing, oh, that's the wrong tool, Lan. Grab the right tool. Let's see. All right. So we want to grab this tool here. So if you see a market that's just doing this kind of thing here, lots of hairy tops and hairy bottoms. All right. Those are called topping tails and bottoming tails, or wicks is what we call them here on these price bars. So these are wicks. And if you see lots of topping wicks and bottoming wicks like this, well, that's not such a good thing. All right. Now, if we're trading over in the stock market, we're going to be trading individual stocks like, Apple, Amazon, Netflix, Google. And there, of course, we got scanners and things that we can play with. And we'll do that on another class. All right. We'll do that in the morning time frame when those markets are moving a little bit more friendly to our day trading. What we're going to be doing today in the afternoon is power hour over in Chicago out of the exchanges there. All right. So you have a lot of leverage in Chicago. Now, it doesn't mean you can't trade Chicago exchanges in the morning. You certainly can. But if we're going to trade some stocks, I'm going to show you those in the morning. All right. In the afternoon and in the morning, there's a great place to trade the Chicago markets, but they have a higher degree of leverage. And so what that means is it just costs you a lot less money to trade. So you can make a lot of money with a small investment because of your leverage over in Chicago at the exchanges there, versus New York, which has very little leverage. So it takes a lot of money to make a small profit. All right, but there's very little leverage. So you put in a lot of money, and if you're wrong, you don't lose as much. But in the Chicago, if you put in a little bit of money and you can lose a lot. All right, because you can make a lot wherever you can make a lot, you can also lose a lot with a small investment. So we have to take that into consideration. But if you only have a small investment, the best place to trade, in my opinion, is the Chicago Mercantile Exchange over here on these indexes. And the reason is because these markets move and you have a lot of leverage out of Chicago. It does take, you have to open up a special account to trade futures, but then you have a special piece of software that's designed just for that. And I'll show you, this is the software I use. All right, so just so you have a little idea of which software I'm using.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so today I'm going to show you my settings for a very simple strategy where it takes a small amount of money to make a large amount of money. All right, so when I say a large amount of money, it's comparative to the investment. So let's just say from this arrow to this arrow, that was about $470. All right, $500, and each one of those price bars represents 2 minutes. So it was 2, 4, 6, 8, 10, 12, about an hour. In about an hour's period of time, that made $470. And how much would we have to invest to trade that? Well, because we're day trading, see, it says day margin right here. So day trading, $1,964. That's all you'd had to have to make that $500 in 1 hour. That's crazy money, all right? I don't care who you are. That's crazy money. You put $10,000 in there and do that. You do the math, how much that would have been, all right? So you can start off small with just one contract, and we call them contracts over in the futures market, but we don't trade shares because one contract represents a specific quantity. All right, the quantity is built into the contract. So the smallest increment that you can trade is one contract in the futures market, and that one contract is a performance bond that you put up, and that is $1,964. All right, $1,964, and that's in the NASDAQ mini. Now there's also a micro, which would be $196, 10 times smaller. All right, and then of course your profit would be 10 times smaller. So if you want to trade with really small amounts, then just to get started, get your feet wet, that's a great idea. That's how you would do it. Okay. But we're going to trade in the mini one. All right. So this is a little bit more money, but it does cost a little bit, $1,964. Now remember, to day trade over in the stock market, we still have pattern day trading rules where you have to have a minimum of $25,000. And of course, if you drop 1 penny below $25,000 and you keep day trading, well, they're going to lock you out for 90 days. We don't want that. So you're going to have like $30,000 in your account to give you that $5,000 buffer so you can trade and not fall into that negative window and get your account frozen for 90 days. Now, we don't do that over here in futures, in the stock in Chicago, in the exchanges over here. We don't lock you out. All right, that's not a thing. We don't turn your account off for 90 days and punish you for being a bad boy. That's not something we do. This is the last bastion of true capitalism on earth today. We figure if you're over here, you pulled your big boy pants on and you know how to trade. So we're not going to penalize you like that. You're just going to lose money. And so we figured that you're smart enough to know how to use stop orders and limit orders and market orders and entry orders and exit orders. And you're going to know how to do all that stuff, which is why you're in this class, right? Which is why you're here learning this kind of stuff at my YouTube channel. So you can do this yourself and not get yourself in trouble. So one of the things that we have to remember when we're using all this leverage in the markets, and we can make a lot of money with a small investment, is that we need to be able to manage our leverage, all right, manage our positions. And so the single most important thing that you need to remember is you do not buy and hold in this market when you're day trading, all right? You do not come in here and you say, well, I'm going to get in, and if it doesn't go in my favor, I'll just sit on it and wait until it comes back and makes me money. If you do that, you're going to get your hiney handed to you. I can promise you that, all right? We don't do that. It's cut your losers short, let your winners run. And that is the first commandment of trading in the futures market when you got this kind of leverage, all right? You cannot sit through those drawdowns. You don't even want to try. Trust me. Ask me how I know, all right? Don't do it. So the best idea is to take your signal, get in. If it doesn't work, get out. All right. Don't think, well, I'll just sit in it and wait for it to come back and then I'll get all my money back. No, these markets can stay irrational longer than you can stay liquid. All right. So you need to get in, and if you're wrong, get out. Just admit it. Really tight stops is how we play this. All right. So what we're looking for is we're looking for signals, locations in the market where we can come in and we can have what we call flat bottom starts. Okay. So we want a flat bottom. We want the first green candle to make a new high. Now this first green candle didn't have a flat bottom. So we want a flat bottom. That's the ones we like. Now we can go off the first green candle, but if it makes a hairy bottom, we just get right back out. You don't stay in. You want flat bottoms on here. Now the reason I got flat bottoms on here is because I'm using a special tool, a special price bar type called Fibonacci. All right. Some of you have heard of Fibonacci. If you turn that off, this is what a normal price bar looks like. A more normal 2-minute price bar looks like in the NASDAQ 100. So I don't like to trade those. That's hard to trade. All right. So I like to use something called Fibonacci bars. And so I turn that on. And in Track and Trade, if you don't have it up here in the bar, you can get it up there. You just right click and say customize my toolbars. It'll bring up your toolbar right here. You slide down to where it says HA, and I've already moved it over, and then you just add it to the price bar. Now, the little custom bar. Now, there's a bar up here. This is the standard Microsoft stuff, right? You're just modifying your price bars. So you can kick this price bar. You got a whole bunch of price bars up here. There's one. You see the little handles? That's how you know which price bar. There's 1, there's 2, and then there's 3. And of course, you can move those price bars around in Track and Trade. You can grab those little price bars by the handle, and you can move them around. All right, so you can bring them over here. You can dock them. You can put it on the left side, the right side. You can put them wherever you want. Of course, I like them up at the top, so we're going to put it back up there. And then to modify it, you just hit custom. Right-click on that handle, gives you this little window, and you can put whatever in there you want. Now, I like to kind of double up some things. You'll see that I got a couple of different arrows. It just makes it easier and more convenient for me to grab them. And so I have the Fibonacci in there. So if you don't have Fibonacci in there, you can right-click on the chart, come down to Chart Preferences, and it's right there. See where it says Fibonacci? It's right there. You can turn it on right there for your chart, and then you can save your settings for that particular chart, and it'll be Fibonacci next time. All right. So that's how you get Fibonacci turned on. And then the indicator that I'm using here is called the average true range. All right. It's my favorite indicator. I really like it. It's one of the wonderful indicators for day trading. And I just click on this little tile right here when you turn it on. So you turn it on, right click, come down here. It says chart overlays. And in the right click menu on the chart, and you come down here to ATR. It's right there. So all you're going to do is you're going to right click on the chart. It's going to give you the right click menu. You say chart overlay. Slide down here to ATR, turn it on, and it gives you this little yellow thing. And then we're going to click on this little tile right here. See this little tile in the bottom right corner? That means that that's active. So we click on it, and it brings you the settings over here in the Preferences tab on the right-hand side. And you'll notice my settings, ATR period 1 and stop factor. I've got it currently set to 6, which is pretty aggressive. I usually start this out at 1. Or 1.0, all right, not 0.1, 1.0. So I usually start here. But if it's at 1, so 1 and 1, then you'll notice that when the market is making nice trends, that little yellow dot is a long ways away from the bars. See that? Big gap in there. So that means I want to tighten it up. If I'm going through a lot of hairy tops and a lot of hairy bottoms, right? Cat whiskers in here, as Claire calls it, then this, you'll notice the yellow dot is too close. So if the dots are too close, going through all the hairy tops and hairy bottoms through the cat whiskers, you don't want to trade. Just simply don't trade. Sit on your hands. Wait till the market starts to move, and then once it starts to get some energy, you can start taking positions. All right. Now I like to have it a little. That's a little kind of a little key right there to let you know when the market's a little bit not tradable. All right. You need to be in a tradable market. And the market will turn on and turn off. It'll go more tradable, less tradable, more tradable, less tradable. And as it's less tradable, you have lots of topping tails and bottoming tails. And then you also, the 1-to-1 ratio of the ATR will sit there and go through those topping and bottoming tails, which is not what you want. So you want to have a market that's moving and trending. And that's when you can trade. All right. So then you should be able to bring this down a little bit tighter. And then you can see you can bring it down to almost 6 or 5 in really good markets that are trading. See how close those little dots are? And it's not getting poked. Okay, those are called spiky dikey doos. So if one comes down and spikes through your yellow dots, well, that's going to stop you out. So like right in here, see where the market started to go sideways? We're in a nice downtrend, but it started to go sideways here with a little spiky dikey doos in there. See how we started getting topping tails and bottoming tails? And we started getting a whole bunch of little cat whiskers in there. Well, to avoid that and not get caught in that, it's an averages game, right? So what we do is we have to back this off a little bit and pull those dots further away so we don't get stopped out as that market's coming down. So the game is to try and figure out where to put those dots so you don't get stopped out, yet they're close enough that you can maximize your profit potential. All right. So that's how that works. So then it's going to take you all the way down, and then we're going to get stopped out right there because we have our trailing stop coming on those yellow dots, and then we get stopped out right there. Now, this is where the market started to die, but then it started to pick up again, but you missed it because you got stopped out right there. Now, you don't have to trail your stops down on those dots. You can hold your stop back at break even and see if the market's not going to go further. But the name of the game is to not give up too much money, right, once you make it. So you can use these dots to help you get in and out of the market. I like to use them to get in, both in and out. And we can use the little arrows if we want to, but I'm going to show you a way to automate it and maybe sometimes do a little bit better than the arrows even. But that's just kind of the quick and dirty strategy right there. Now, we are looking at some of these other markets down here. This is kind of telling us when the market's overbought or oversold. But you can see that the stochastics line in here, usually when the stochastics is way up here in the top region, that's when you want to take your down arrows. And when it's way down here in the bottom region, this is when you want to take your up arrows. All right. And since the market's in a downtrend, which means we're having lower highs and lower lows, then we kind of generally only want to take the downtrends. We don't want to take the uptrends. Not that you can't, you certainly can. And when you're just taking little short trades, oftentimes the counter trends are okay. But generally, in the beginning, when you're new, you probably want to try to avoid the counter trends. So a trend is, if the trend is down, lower highs and lower lows, the trend is down, you're only going to want to take short positions. The counter trends are oftentimes too short. So then you get another long one like that. So you only want to take the long trends. The little counter trends are oftentimes right, a little bit too short. So you get the longer trends, and then you get the shorter trends. Now, in this case, that little counter trend was a pretty good little trend, right? Can't complain about that. But the downtrend was actually a little choppy, whereas the uptrend was a little bit better. But that's just the nature of the beast, all right? Now, we're on a 2-minute chart, which kind of smooths things out a little bit more. We can come down here to a 1-minute chart as well. Let's come over here to our charts tab, and we'll change that over to a 1-minute chart. All right. So a 1-minute chart gives you a little bit more granularity, of course. And we're going to turn on Fibonacci on our 1-minute chart. And that's what a 1-minute chart looks like. And so now you can see that you got a little bit more. And see, oh, look at that. See, you had a nice little downtrend, but you had a little spiky dikey do in there that kind of hit our yellow dots. And that's a nasty little thing that happened right there. Doesn't mean you can't get back in. You certainly can. If it stops you out and it starts going back down, you get a flat bottom, throw your order back in there and see if it won't go to another leg. All right. So this is a little ABC pattern in here is what we call that. A, B, C, a little pennant formation. And then it dropped one more time right down to 130.9, 161.8, just like a train on rails. Right straight out of the manual. The manual? What manual? The manual, the computer, the stock market manual, how to trade the stock market manual. I didn't know there was a stock market manual. Of course there's a stock market manual. You just go search Lan H. Turner out on Amazon, and you got a stock market, how to trade the stock market manual, and it teaches you all this stuff I'm showing you right here. All right, so on Amazon, search Lan H. Turner. You have to put the H in there, or else I don't come up. All right. So you have to put up the H. All right, here's another little ABC pattern. All right, so you got a trend, which is down. You got a counter trend, which is up. And then you got the next trend, which is all the way down to 130.9 again. 130.9, the reason I point that out is because that's a golden ratio. All right, just like 61.8 is a golden ratio. For those of you who are Fibonacci aficionados, you know that 130.9 is the opposite of that. All right, instead of a retracement, 130.9 is the Fibonacci projection level. All right, so that's what that is. And we're going to come in here and we're going to look now. This is another counter trend. Now, how would we know if the market was going to reverse and go the other direction? Well, first of all, we'd look for a little head and shoulders formation, right? We're going to look for these different reoccurring price patterns. So we come in here, that would be your left shoulder, that's your neckline, that's your head. We'd look for a little rally, a little pullback, a right shoulder that didn't break the previous low, right? So we no longer have lower lows and lower highs. We'd look for, anticipate another rally here, and then we look for the market to continue to make the reversal. All right. Now, if the market does come down and breaks a new low, then you'd have to move this whole thing down. You grab the whole thing down and go down to the next level. Maybe that one right there would be your left shoulder, and we'd look for a head down in here somewhere, and then a neckline and a little right shoulder, and then that's where we would anticipate a reversal. All right, depends on what this little thing right here is doing. It's getting kind of ugly right now. We only got 30 minutes left before the market closes, but that's kind of how we read these markets on a longer term day trading style basis, as opposed to a scalping basis, which is scalping. We're just trying to get in and take 5 ticks out of the market. Now we can do that, and we talk about that in this class, and we've talked about it in other classes. We can do that, but in this class we're not going to spend so much time just looking at the scalp. We're going to go a little bit more for the trail, what I call the scalp and trail strategy. All right, so this looks like this is a little bit beautiful downtrend right here. Look at that. So we got this nice little ABC pattern happening from down to here, up here. It came back, spiked us out. Now it's giving us another little down. Probably, maybe if it does the same thing as last time, back down into this region here. That 130.9 is our golden ratio, but we like 90 to 100. That's a good level to see markets come to. Of course, there's 61.8. And these are, of course, areas where you can take profits along the way. So if you get in and you take a position, let's say we got in with 5 contracts, well, you could take one off here, you could take a couple off here, you could take one off here and let the other one run. And so you could take profits off along the way. That's what I call that. And I like to do that. I like to take profits along the way. So if you're going to get in with multiple contracts, but you have to take a bigger risk in the beginning to get in with multiple contracts. If you just want to get in with one contract, well, then you don't have the ability to take profits along the way. You just take your one profit off, and usually that's the scalper. So we need at least 2 to do a scalp and a trail. So this is coming in here now, and so this is a spot where we could actually take a short position. All right, and we've got a little stop right there. See the little yellow dot right there? So we could come in here and say, well, I think this market's going to continue down. So we could just hit sell just like that. And now our risk is between where we get in and where we'd get out. Now remember, we're not going to just hang on and say, well, if it goes against me, I'll just hang on until it comes down, because it could just turn and go up and you'd be down thousands of dollars before it ever turned around and came back down again. You don't want to do that. So what we're going to do is we're going to put our stop right on that little yellow dot. So you can just grab your stop, and then track and trade's a drag and drop order tool. So you just drag it right on the screen just like that. There you go. Now you got your stop in there. You don't have to fill out any little order ticket or anything. This really makes it nice and easy. Kirk saying, can we make the width of the spiky dikey doos wider to see them a bit easier? Yes, you can. You can come in here and you can come in and you say chart proportional width. So you right click on the chart, Kirk, and you say proportional width, and you can see it makes the bars thicker. If you like a little thicker bar, then there you go. I could also come in here and use these little arrow buttons down here, and I could make these bigger. And I should probably do that for you guys who are on the internet to make these bars bigger so you can see them a little better. All right, so that's how you do it. And then you can proportional width, turn them back down like that. So if that works better, we'll leave it like that. Now see that little yellow dot? I got a new price bar and the new little yellow dot. See, I'll move that out of the way. You can just grab that and move it. See, it's right there. The little dot came in closer. So that should be on that little dot. So I can move it by myself, just put it right down there. And if I get stopped out, I have a very small loss. All right, I have a small loss, the distance between where I got in and where I get out. If I'm wrong, and I'm just going to follow those little yellow dots all the way down. As long as it's down below those little yellow dots, I'm going to stay in the market. But as soon as it touches the little yellow dot, well, I get out. Now, the great thing about track and trade is that you can come in here and drop your stop order at any point along the way. You can put it wherever you want, but it also will trail those little yellow dots for you all by yourself. So you can come in here, look, I can put that up there, and then you say, well, follow the yellow dot. So just like Dorothy and the Scarecrow, you come in here and you go edit the order, and you say trail on the yellow brick road, which is ATR stop. All right. So we come in here and it's going to trail on the yellow brick road. There we go. Now we're trailing the yellow brick road down. Now, if the market turns around right here and comes back up and spiky dikey doos the yellow brick road, well, we get stopped out with a small loss. But we can have small losses. That's okay, because when we win, we're going to win a lot. And when we lose, we're going to lose a very small amount because we're not going to take big risks, right? And so however far that little yellow dot or the yellow brick road stays behind the price bars is how big of a risk you're going to take. Now, if you take too small of a risk, you get stopped out only to have the market take and go off on it without you, right? Oh, look, see, now we're getting spiky dikey dude going the wrong direction. So we got stopped out with a small loss. That's no fun. So we got the first green candle to make a new high. This is a counter trend. You can take the counter trend if you want to. We'll get an arrow right here in just a second. This is a 1 minute chart. You can see the countdown right here, 003433. So in 33 seconds, we're going to get a new arrow. You could preempt it if you wanted to. You just come in here, well, I think it's going to go up, and you hit buy market before you get the arrow. That's okay. Nothing wrong with that if that's what you want to do. Or you can wait for the arrow to come up, or you can, there's other strategies you can do to enter on the crossover of the yellow dot, and we can automate that too. So if we got time, I'll show you that too. So let's see what happens here. We're just going to, now this would be a counter trend, right? Because we got, the market went from here, 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 kind of did this funny little thing here. Now we got an up here. So if that was a counter trend, we'd expect it not to go very far. But if it's a reversal, could be a reversal. So we're going to go in, and then we're going to put our stop right here on the yellow brick road, just like that. Now we're going to come in here. I'm going to right click on that and say edit, and I'm going to trail the yellow brick road all by itself, ATR. All right. Now, I don't know if we expect this thing to rally or not. It's still in a downtrend. We haven't confirmed with our head and shoulders formation this is an uptrend. I'm just showing you how to do it. So now we're going to anticipate that the market continues to rise. If it doesn't, it'll stop us out. Comes down, hits the yellow brick road, it'll stop us out again. So if we get but we got a flat bottom there. That's a good sign for a long position. Let's see if it'll continue. I don't know. We're getting a little bottoming tail on that one already. So we're just kind of holding tight on here. Have a little drawdown. All right. How many of you guys are going to see the Wizard of Oz down in Las Vegas at the Stratosphere thing? Is it Stratosphere? No, not Stratosphere. The round ball thing, that big round ball theater. I got my tickets, not till September, mid-September, but I got my tickets. We're going to go see. So I like this, calling this the yellow brick road. Uh-oh, we just got stopped out again on the yellow brick road. So it's just popping back and forth across the yellow brick road right now. We're not getting a nice trend out of it, but we'll have to wait and see. We just got spiky dikey dude out. In September, I'm going to Wizard of Oz in Las Vegas in the big round theater thing. Now, if this continues to break higher, we might just get back in because we got spiky dikey dude out. So we could do that too. And we'll put our stop back in there. There's lots of ways you can trade this. Usually, I don't know if you want to be that aggressive. Once you get stopped out, you might want to just wait for the next signal. That's probably a better idea, but you can play it however you want. All right. Just make sure you put your stop in so that if you are wrong, you get stopped out. You don't take a big loss. You're like, but then I keep getting stopped out. Well, then you're trading. Your signals aren't that good. It's not the fact that you're getting stopped out. You got one or two problems. One, you're trading when you shouldn't be because the market's not moving and pumping and hopping, and it's not trending. So you're trading at the wrong time of day or during a wrong, a wrong moment in time, or your stops are too close. And if you hold them too close, then you can keep getting stopped out even though the market's trending. Now ours, I don't think ours are too close. You look at the little yellow brick road right there, and they seem to be in a pretty good location. It's just that right here at the bottom of the hour at 1:30, the market died. It's just dead. So we have to wait and see. We're just trading with one contract. We're not getting crazy with like 3 to 5, 10, 15 contracts. We're just trading a little bit. So we'll see. But this is how you do it. It doesn't have to be too hard. You can just kind of sit here and gauge where it's going on this little yellow brick road and try and stay on the right side of the yellow brick road. That's it. Play the Wizard of Oz. All right, we got two little red bars. Let's see if this one will be a green bar and continue the uptrend. We'll get a little ABC pattern out of here. A, B, C down. Maybe it'll go up to 130, 90, 100, 130.9. That would be nice, right? That'd be a 50% retracement, basically, of that last drop. So maybe we're working our way back up into this region here. It'd be nice to see it come back up into here. If it could come up into here, we'd be making a little bit of money. Now, what I like to do, and I'm a little scaredy cat when I trade, all right? And it's okay to be a scaredy cat because that's what keeps you from losing a whole bunch of money. When you're brave, that's usually when you Actually, you need to be. The problem with most people is they're brave when they should be scared, and they're scared when they should be brave. So when they're losing money, they're very brave. Oh, I'm losing money. I'm just going to stay in. Oh, it'll be okay. It'll come out. It'll come back for me. And then when they're making money, they're scared. Oh no, I'm making money. I'm scared to death. I better get out and take my profits. Any profit is better than no profit at all. You know, all those stories. The name of the game is to cut your losers short, let your winners run. So when you're in the market making money, that's when you need to be brave. Stay in, make more money. All right. When you're losing money, don't stay in. That's when you need to be scared. Most people do it just the opposite. They're brave when they should be scared, and they're scared when they should be brave. All right. Now, one thing I like to do, and I have to admit, I'm a little bit scared when I trade like this and I get down. All right. Now, there's another tool in here I'm going to show you. We're going to get rid of this little trailing stop because it's not attached to our order. All right. These are two separate orders. Now, I'm going to make this one ticket. Come in here, right click on it and say add OCO. Now it puts two orders in there. One is the trailing stop that we had before we just got rid of, and one is a limit order to take a profit. All right. Now we're down $355. So what I like to do sometimes, I like to come in, set my stop. I'm going to put that on the trail on the ATR. Since it's an OCO, I have to use this section down here of the order ticket, not this one up here. And I'm going to trail it on the yellow brick road on ATR, just like we did before. So it's trailing on the yellow brick road, and I'm going to come in here and notice this little number over here. That tells you how much money you're going to take profits at. We're down $355. So we could put this on $355. We could come in here and say if it makes $370, cover the commissions and fees, well, then I'm just going to get out, take my profits. Otherwise, I'm just going to let this trail up. Well, it's already trailed up to break even, so at least I'm at break even. If it goes up and hits our limit order, we'll take our profits off at $355. And then we'll be back to zero. We won't be down any money. We will have made back our money. Then we can wait for another setup and we can trade again. So that's how that goes. Good to see you, buddy. How you doing? Glad to have you. All right, here we go. Let's go up there and see if it'll give us those 74 ticks. That's all we need to break even. You know, you could let it run if you wanted to. A lot of people will tell you not to, but I like to say is if I'm down, if I go down very first thing right out of the gate, I just want to get my money back, get me back to break even. Then I can start waiting for another setup. And if this market goes to the moon, well, that's the nature of the beast. So I just want to get my money back. Okay, there we are. We're back to break even. Now this market could keep going and make a whole lot of money, but for me, can breathe. All right. I'm not down $355. I got my $355 back. So now what I can do is I can wait for another setup and I can trade again from a point of strength instead of from a point of weakness. So see how that works? That's how I did that. That's a nice little strategy for beginner traders. All right. Now, if you're a little bit more advanced, you're like, no, Lan, I feel comfortable staying in the market. I don't need to take my profits at $355. I can just let this thing run and see if I can't make more than $355. Well, do that. That's okay too. That's why there's markets. Lots of people doing different things. All right. So now this market's doing really well. We're kicking butt right down here. We picked up this little arrow. We had a little choppy right in here, but we didn't get stopped out, or did we? I can't remember. Did we get stopped out on this little yellow dot right here? It looks like it touched it, so we might have got stopped out on that one. But then we put ourselves back in. Now we're up here. The market's really doing well. So we already made our $355 back. So at least we're not down $355. We're back at break even. We feel good about that. Now we just have to sit and wait for another opportunity to get into the market. Well, Lan, jump in right now. Well, there's no arrow now. There's no buy signal here. Why would I get in right here? That'd be a scary spot to get in. What if I got in and the market flushed? There's no arrow. There's no setup. There's no trigger. There's no breaking of a trend line. There's nothing there to tell me that it's time to get in. And not only that, we're reaching up into our Fibonacci sweet spot, right, which is where we anticipated this thing coming to, which was in that little circle spot right there between 61.8 and 38.2. We're right there at the peak right now, hitting 61.8, which is our golden ratio, right? That's our little magic number, 61.8. It's right there right now. So I wouldn't want to be getting in right here. We might want to be looking to get in for the next down leg, right? So then we got down, we got a short up, then we might get another long down. I don't know. We only have 25 minutes till the market closes. What do you think the market's going to do? You think it's going to keep going up? Or do you think people are going to start getting out? They're buying in right now. Of course, they had a lot of short positions on right here. These are shorts, and to get out of shorts, you have to buy. So that's what causes markets to pop back up. They're getting out of their long positions, so they pop them up, and then again, it went short. They get more guys are getting out now. A little bit of here now. I think more guys are getting out. This might be getting out. I don't know if they're getting in. This might be guys just getting out from the long short, from the big short position they had, which is drawing it back up. You have to buy to get out, right? This looks like buying to me, though, because lots of flat bottoms. I think guys are buying this. Now, that's a little, what we call a little pennant formation in there. If you want to trade that, you can. Well, let me see if I can draw it straight. So there's a little pennant formation like that across the top down here. So you have lower highs and higher lows. That's a pennant formation. It's coming into a little consolidation area. Little consolidation like that, and then the breakout of the consolidation is oftentimes the direction the market will go. So if it breaks out the top, we'd anticipate higher prices. If it breaks out the bottom, we'd anticipate lower prices. Of course, you can also get false breakouts. All right, so you have what we call a bull trap. So you get in here, and then it turns around and flushes like that. So it gets everybody in on a break above, and they all jump in only to have the market flush out from under them. It's called a bull trap. All right. A bear trap would be the opposite, right? It would come down, get everybody in thinking it's going to go short, only to turn around and go back up. That would be a bear trap. So you have bull traps and bear traps. So be careful with these little pennant formations because they can be traps. So there's no arrow, there's no crossing of our yellow dots, there's no setup or anything. Now, we could trail up on this. Now, this is another little strategy. This is a good opportunity to show you something. We could say, well, what if I think this market's going to flush down on a break of those little yellow dots? Well, I can come in here with an open stop order, stops for entry. I can get in with a stop order. When it crosses that yellow dot, I might take a short position, all right, make money when the market goes down. And of course, I can have it automatically trail on that yellow dot. Looks like it's going to hit it, and I'm not going to get a chance to make it auto trail. There we go. So we're short the market. Now, when it does that, you got to immediately put your stop order in on the other side. Now, of course, we can do that two ways. We can come in and drop our stop right up in here, just like that. Or we can come in here, and I can delete this one by right-clicking on it. Or I can come in here, right-click on that order, and say Add OCO, and then I can put these orders in, right? Now, right now, I don't have a yellow dot up there. It didn't flip. So I have to wait for that yellow dot to flip. In the meantime, I'm just going to bring it right down above that red bar. All right. And then down here, I can put a limit order for profits if I want to. Now we can say, well, if you make me $300, see right there, $300. If you make me $300, I'll just get out. I'll be happy with $300. But what if it turns and goes back up again? Starts to go back up here. Well, we got our stop in here to stop us out again, so that we don't lose a whole bunch of money. And when I wait for the yellow brick road to flip to the other side, sometimes we'll get a big rally like this. We'll get two little red bars like that. That's a counter trend, and it'll turn and take off like a rocket ship. So if you want to, you can say, well, I'm going to try and take this one down in anticipation of the longer term downtrend. Here, looking for this downtrend, right? We don't know. It looks like that. Oh, look, the yellow brick road flipped to the other side. So now we can come in here. I'm going to get rid of all these little arrows, delete all the arrows. And I can say, look, there's the yellow brick road. I'm just going to take this, right click, edit, and I can tell it to trail on the yellow brick road. There we go. And it's going to move automatically for me. Now, if it comes down and hits this limit order, it's going to give me $300, and I'll be out of the trade again. I wait for another setup, another opportunity to take $300. There's a little bit more scalping, a little bit longer term scalp. Scalps are oftentimes like 5 ticks, which we'd have already been out on. This is a little bit more of a day trading, what I would consider more of a short term day trade, right? Try to catch her a little bit more than 5 ticks. Of course, you risk more to try to get more. You risk the market coming back. We're up $70, $80. You're like, well, just take it, lad, take it. Well, you could, but what if it keeps going? Or it could turn around and go back and hit our yellow brick road and stop us out with a loss. Because right now, yellow brick road, well, it just jumped. So it's right at break even right now. So if it does go back and hit the yellow dot, at least we won't lose anything. All right. And you say, but Len, you're only making $300 a day, $500 a day. That's not enough. That guy over on the other channel, he makes $15,000, $18,000, $25,000 a day. I want to be like him. Well, the difference between what we're doing here and what he's doing is just a quantity. just increase the quantity, do the exact same thing, and now you'd be doing the $25,000 a day like he says he's making. All right, it's just a quantity thing. We're still playing the same strategy, basically red to greens, little arrows crossing the natural trend lines, that kind of stuff. And once you do that, you get this all figured out. We just took $315 out of the market. Now, we can risk that $315, go try another trade, or you can say, oh, $315 good for me today. I'm happy. I had $300. I'd have had to work, at the gas station for 8 hours to make that. And we just made it here in 40 minutes. I don't know. It just depends on what you want. I have a lot of guys come to me and say, if I can't make $2,000 a day, I ain't doing it. It ain't worth my time. $2,000 a day. Okay, well, just trade a larger quantity. It just takes bigger cojones. Just trade larger quantities. That's all it means. Just takes a little bit of experience and a little bit more ability to judge whether you think this market is trending well enough to put a larger position on, right? That's all. How big are your cojones? Well, I got big cojones. Okay, well then put on 14 contracts and hit that buy button, and it doesn't have to go very far with 14 contracts. Well, how much money would I have to have in my account for 14 contracts? Well, 14 contracts, it tells you right there. See? Day margin, 14 contracts, $27,000. Oh, I don't have 27,000 in my account. How much do you have? There's 7. 13,000, 11,000, 5,000, 6,000, 3,000. How much do you have in your account? There's quantity 1, 2,000. I have about $5,000 in my account, Lan. Well, you could trade 2 contracts then, because that's $3,900. 2 contracts. Let's take this and say, well, if you'd have got in on that yellow crossover, which we should have done, with 2 contracts, we can come in here to the dollar calculator, preferences, quantity 2. That would be, you need to make your $2,000 a day. The market would have to go to about right there, and that would be it. So 2 contracts from this low to this high would have easily been $2,000. All right, that's about 2,000 grand right there with 2 contracts. There's your $2,000 run, 2 contracts. And how much you have to have to trade 2 contracts? You have to have $3,929. Tells you right there. All right. What about down from here? What if you got in right here on this yellow dot? Let's put it right on the yellow dot, and we got out on the yellow dot right here with 2 contracts. Well, with 2 contracts, that'd have been $1,560 from this yellow dot to this yellow dot. $1,560, 2 contracts. All right, for a $3,929 investment. I'm going to be rich, rich, rich beyond my wildest dreams. Well, that's all there is to it. You just got to have big cojones and willing to do it. That's too scary. I can't do that. Okay, well, we got an answer for you guys too. Come over here. We'll come down to the 1-minute chart on the micro. All right, so we're going to go down to the 1-minute chart on the micro. Turn on our Heikin-Ashi bars. Turn off this one here. We don't need that. And let's go to our ATR. We had it on 6. That's the same. So there's the exact same market. I'm going to blow it up a little bit bigger. All right. Come in here, turn on our proportional width. And we're going to draw a couple of dollar signs in here. 2 contracts from this yellow dot to this yellow dot with the micro. See, 2 contracts. Boom. Would have been $158. All right, $158 from here to here, 2 contracts in the micro account. How much money would I need to place that one, Lan? I feel more comfortable with that smaller account. Well, come over here to trade. It tells you right there, $343. That's all you'd had to put into the market. $343. Ride that thing all the way from that red dot to that red dot, the little yellow dot down that red trend. That'd have been $158 with a $343 investment. That's pretty good money. Can't complain. All right. And you're not taking the big risks that you would if you were trading the other market. This is called the micro. All right. Micro. Let's pretend that we got in on that yellow dot crossover like we were talking right there. That'd have been a $60 move for a single contract. If we put in our 2 contracts, preferences, 2 contracts, that'd have been $120. We'd be up $120 on a micro. That'd be $1,200 on the mini. Right, with 2 contracts. So if we come back over to the mini on the 1-minute chart, that move right there from this yellow dot to where it's currently trading, $650 per contract times 2, you're going to be up almost $1,300 right now. All right. That's how it works. That's how it works. So you have to decide which market makes you feel more comfortable, but you can trade either one. And it's basically the same. We kind of missed our opportunity. Land, get in. We missed it because we were talking too much. That's okay. We're learning. This is a learning environment, right? So we got our trend lines. Now, one thing I want you to always remember, all right, there's one up for every down. There's one up for every down when you trade the markets. A lot of people don't realize that. There's one up for every down. And those little arrows, they show you the beginning of each up and the beginning of each down. All right. So there's our indication. I got my alarm went off. Says we got 15 minutes till the market closes. So there's one up for every down. See that? If you just draw a little trend line in there, there's one up for every down. The only problem is we don't know how long the up is going to last. We don't know how long the down is going to last. So it is a carnival game. All right. And I'm not going to call it gambling because it's not gambling. We're not going down to Las Vegas. We're not trading black and red because we can sit here and strategically analyze this thing. It's more like a carnival game. You can go into a carnival and you go down the fairway with all the tents and you can pick one that says, hey, I think I can figure out how they're playing that game. I think I could get pretty good at that carnival game right there. I could throw darts really well. I can practice throwing darts and I could do better at this carnival game. But yes, you can practice at gambling, but if you're going to go pull a lever or if you're going to put black or red or pick a number, 28, I'm going to put it on number 19 or whatever you are, there's only so much you can do. You say, well, I can play blackjack. Yes, it's true. And you can kind of play to try and put the odds a little bit better in your favor. But in the stock market or in the futures market, when we trade this, we have a much better chance of putting the odds in our favor than we do gambling. Gambling, it's always what they call a gambler's fallacy, where you think that you got the odds higher in your favor because you saw something or you think you saw something happen. Like when you spin the wheel and, well, it's had black 3 times in a row. It's got to have a red here pretty soon. No, it doesn't. Whatever happened before has nothing to do with what it's doing now. You have the exact same odds every single time they whip that wheel. Has nothing to do with the previous set of 10 rolls. Nothing at all. They show it to you on a bar, but it means absolutely nothing. You got the same odds every time. But when you go to the carnival game, it's a skill. All right. I can throw the darts good. I can go home and practice throwing darts. And so then I can go down to the carnival and I can throw darts and I can beat those guys and I can get me a big stuffed animal. All right. Or you go and throw hoops. Now they put the hoops, make them smaller, and they put them farther away than the ones you're used to at home in the driveway. So you got to realize I got to practice on the one that they're giving me, which is farther away and a smaller hoop and a little bit heavier ball that's a little bit smaller around. So you got to have the same. Yeah, right. You can't go practice this and then go do that and think you're going to be the same. Can't do it. Doesn't work that way. That's why they change it up, because they know you've practiced with this ball and with this size hoop and from this distance, and they change all that up on you. So it's not the same at the carnival. But if you know what the carnival's got, you can go in there and you can practice what the carnival sets up for you, and you can get good at it, and you can beat the carnival. That's what that's why I always say that the stock market is more like a carnival game than it is a gambler's game. Because a gambler, you have the same risk every single time, the same odds that you're going to lose every single time, but not at the carnival. At the carnival, you can put the odds in your favor. Now they're stacked against you on purpose. You're meant to lose, just like in the stock market. You're meant to lose. You're not meant to win this game. All right. But if you get good at it and you practice and you get the right tools and you got skill, you can beat the carnival. Even though they don't want you to take their big the giant panda, you can take the giant panda because you might be able to beat this skill level by just learning a little bit and practicing and getting good at it. All right. So it's a game of skill, and you can get good at it, and you can win. You can beat the market. You can win the big panda. But the real name of the game is to cut your losers short, let your winners run. You take your setups, you take your high probability setups and triggers, and if they don't pan out, you get right back out immediately. Like right now, if this thing doesn't take off and go to the moon, immediately take off and go to the moon. With our 2 contracts on a break above that high, we're just going to get back out. We're not going to take a big loss. Now, we'll probably lose everything we got in there, which is $315 because we went in with 2 contracts. And if it goes, we'll make a bunch of money. Does anybody know whether it's going to go or not? No, nobody knows. So you just got to take your chance. It's like being at the carnival game. If you don't ever throw the basketball into the hoop, you can't ever win. So you got to throw the ball, even though it's going to be hard. All right. I don't know if I'm going to make the basket, but I got to try. I don't know if when I throw the darts, if I'm going to pop a balloon, but I got to try. If I don't ever try, I never make any money. I never pop any balloons. I'll never get me a big panda. All right, it popped in our favor. That's good. We want to see that thing go. Go, 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 baby, go. Don't stop on us now. We got 10 minutes till the bell closes. That was our 10-minute ring. Oftentimes 10 minutes. 10 minutes before the bell, that thing goes back and forth a lot. We're lucky it popped up and didn't pop down and stop us out. I generally don't want to be trading during the 10-minute bell. All right, so we got 10 minutes before the bell closes. You can watch that. Watch your clock. Make sure you don't have a position on. Watch your little timer. Make sure you don't have your positions on at the 10-minute bell. That's when I think a lot of quant systems turn off their systems, flatten their positions at the 10-minute bell. And so, boom, the market jumps all over the place. All right, we need it to go. Oh, we were just up $300. We had doubled our money right there. We could have scalped it out. If you're getting a little nervous right now, you can just take it off. You can say, look, it's not going. I wanted it to go faster than that, and it's not going. Or you can just let it go, let it ride. I'm going to let it ride, see if it won't keep going higher. You can put your limit order in there and take it off. You can say, I'm happy. If it went up there and just touched that high right there and tested that high, I might want to take it off. And if you did, you'd be up, if that'd be over $600 we'd make today on that trade right there. That's more of a scalp right there. It's a little bit of a scalp. Getting a little nervous right here. It's not going up very fast, which oftentimes when that happens, it breaks above a previous high. And if it doesn't just kind of take off and go, then it kind of flushes and goes back down. It doesn't go. So oftentimes I'll just say, you know what? I don't trust it. I'm not going to let it take any money away from me with a loss. I got out. We didn't make anything, but we also didn't lose anything. So you got to learn to read the market. You kind of get a feel for it because you've watched it enough. You're like, well, I don't trust it. I don't trust the market. I don't trust it to go up. Doesn't mean it can't. Look, it might turn and go back up and then we'll feel bad. But if it would have flushed and gone down, we wouldn't feel bad. You just don't ever know. But if it just didn't go, it didn't keep making higher highs and higher lows. I want it just to keep going. It didn't do it. So I just got out. I wait for another opportunity. All right. Now, I'm not going to have another opportunity because the market's getting ready to close, but I might have another opportunity tomorrow, right? Doesn't mean we can't come back and do this again tomorrow. At least today, we're not walking away red. We're walking away with $325. That's not a bad day. A lot of people would be sad about only making $325, but you can be happy about making $325 in 45 minutes. That's more than I can make working at the gas station. It's getting a little quiet right now. It's trying to go back up. It's breaking that previous high. So if you wanted to, you could take another entry, come in here and drop one in there and see if it wants to go right here in the last 5 minutes of the market. See if it wants to go a little bit higher, but I don't trust it. So I wouldn't do it. I just sit here on my hands. All right, guys, that's my lesson for today. What I want you to do is I want you to practice this until we'll come back and we'll do it again next Wednesday. Tomorrow morning, bright and early, 8 o'clock in the morning, we're going to talk about our UBI, Universal Basic Income portfolio. I'm going to show you where I'm got my money and where I'm putting it and where I'm rebalancing my portfolio. I'm in the middle of rebalancing. This is September, and that's the rebalancing month. So I'm rebalancing my portfolio, and I'm going to show you how to do that. So if you're not part of that group, come and join us tomorrow morning, bright and early, to rebalance your portfolios as well. And we'll show you how that's done. I'll show you my real money account tomorrow, show you all the money I got in there, real money, show you how I'm doing it. Look at this. It's breaking out of our little pin-up formation and the way it's going, trying to break a previous high right there. It's trying. Come on, buddy. Let's see if you can break up there. See, if we'd have stayed in, our little dots never did get hit. But of course, it didn't go very high either. It's kind of losing its momentum right now. So we'll leave with $325 and we'll not complain. All right, so join me tomorrow morning, 8 o'clock, bright and early. And next Wednesday, we'll come back and circle around and we'll do this again. We're in summer schedule right now, so we're on a light schedule. School starts here in October, and we're going to start going every single day when class starts up. I'm a teacher at the university, so these are university lab classes. And so summertime, we're on a summer schedule. We only meet 3 times a week. During the school year, we meet every single day in the labs. All right, and of course, we got classes too. We got to go to classes. But if you can't make the classes because you don't live close enough, that's okay. You can just come to the labs. All right, we got some fun stuff we want to show you. Let's play with AI a little bit, and got to talk to you about Pit News Magazine, because Pit News Magazine is something that everybody should have. Of course, Pit News Magazine is a club magazine, and it's what allows us to share the information that we got here. We talk about in class, and then we publish it and print it all in a magazine. It comes out once a month. It's $39.95 a year for a whole year magazine subscription. It's got audio. Every single one of the articles are all recorded. It's a really cool little thing. I would recommend you get it. It's over at pitnews.com. And here's a little ditty about it, okay? So you can get the information you need to sign up.
Ready to level up your news game? Welcome to Pit News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pit News Magazine. News your way.
All right, that's Pit News. I'd like you guys to come and join us over at Pit News. Here's something funny that Claire made for us.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pit News Magazine. You can thank me later.
Yep, thank me later. All right, guys, that's all I got for you today. We're going to catch you tomorrow morning, bright and early at 8 a.m. See you here. Don't be late.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.